The plumbing of our economy is cracking. Reinsurers shun US risks. Primaries hike rates to the moon or bolt, forcing states to play fireman with your taxes. This is capital's verdict on climate chaos. For the few who can flee, not the many trapped. Let me be clear about what we are witnessing. The insurance crisis unfolding across America is not a market failure. It is the market working exactly as designed. Capital withdrawing from risk it can no longer profitably manage, and offloading the cost onto ordinary families and public backstops. This is not an accident. It is the logical endpoint of an economic system that externalizes climate destruction for a century and then abandons those left holding the bag when the bill comes due. Start with the numbers, because they tell a story of organized retreat. Since 2019, over 150,000 households in California's extreme fire risk zones have lost private insurance coverage. That is 1 in 5 homes in those areas now standing naked before the flames. State Farm alone announced it would not renew more than 30,000 homeowner and condominium policies in 2024. One homeowner in Pacific Palisades watched her annual premium leap from $4,500 to $18,000. Not because she filed a claim, not because she was reckless, but because the actuarial tables now say her home sits in a sacrifice zone. This is not isolated to California. Insurers reported losses on homeowners' policies in 18 states in 2023, up from just 8 states a decade earlier. The geography of abandonment is expanding. Wildfires in the west, hurricanes battering the south, storms pummeling the Midwest. Climate disasters that once seemed regional now cascade across the country simultaneously, overwhelming the risk models that insurers built in a more stable climate. And so they exit. They non-renew. They hike premiums beyond what working families can afford. They retreat to safer, more profitable markets and leave you behind. But to understand why this retreat is accelerating now, you must look upstream to the reinsurance market. Reinsurers are the insurers of insurers. They are the ones who absorb the catastrophic tail risk, the mega fires and superstorms that would bankrupt a primary insurer. Giants like Swiss Re and Munich Re have spent decades spreading risk globally, allowing your local insurer to underwrite your home without betting the company on a single wildfire season. But now, reinsurers are pulling back from US homeowners' markets. They are raising prices by 50% or more, or refusing to underwrite certain risks altogether. When reinsurers ghost the market, primary insurers lose the capital cushion they need to stay in business. They cannot afford to hold the risk on their own balance sheets, so they do the only thing capital knows how to do. They exit. This is the choke point. The mechanism is simple and brutal. Primary insurers buy reinsurance to spread catastrophic risk. When reinsurers exit or price their coverage beyond reach, primaries cannot afford to stay. They non-renew policies, they hike rates, they flee to safer geographies. The homeowner sees only the cancellation notice or the quadrupled premium. But the real decision was made in a Zurich boardroom or a Bermuda reinsurance hub, where global capital decided that American homes are no longer worth the risk. And where do those homeowners go when the private market abandons them? They flood into state-backed insurers of last resort. In California, that is the FAIR plan. In 2020, the FAIR plan covered around 210,000 homes. By 2024, that number had more than doubled to over 463,000. Total exposure has nearly tripled to over $450 billion. Think about that for a moment. $450 billion in insured value sitting in a public backstop that was never designed to be the primary market. One major fire, like the Los Angeles fires in early 2025, could consume 40% of the FAIR plan's annual resources in a single event. What happens when the FAIR plan runs out of money? It imposes assessments on the remaining private insurers, who pass those costs on to all their policyholders. So even if you live in a low-risk area, you pay for the losses in the high-risk zones. And if the FAIR plan becomes insolvent, the state steps in. That means taxpayers foot the bill. This is the socialization mechanism in its purest form. Insurers collected premiums for decades when the risk was manageable. They built profits, paid dividends, bought back shares. Now that climate chaos has made the risk unmanageable, they exit, and the public absorbs the losses. Privatize the gains, socialize the losses. It is the oldest trick in capital's playbook. But let us zoom out, because this is not just about insurance. It is about the entire architecture of home ownership and wealth in America. When a home becomes uninsurable, it becomes unmortgageable. Lenders require insurance as a condition of the loan. No insurance means no mortgage. No mortgage means no buyers. No buyers means property values collapse. Local tax bases erode. Municipal budgets crater. Schools, fire departments, infrastructure, all of it depends on property tax revenue. When that revenue vanishes, entire communities face economic collapse. The insurance crisis is not contained. It cascades through the real economy, through the housing market, through local government finances, through the lives of millions of families who did nothing wrong except live in a place that capital has now deemed expendable. And here is the bitter irony. Insurers are not going broke. They remain highly profitable in other lines of business: commercial insurance, life insurance, specialty products. They are not abandoning insurance as a whole. They are selectively abandoning homeowners' coverage in climate risk zones because it is no longer profitable. Capital is reallocating to safer, more lucrative markets. The insurance giants are fine. It is you who are left exposed. This selective retreat should remind us of something. It echoes the redlining of the mid-20th century, when banks and insurers drew red lines around neighborhoods they deemed too risky, usually black and brown neighborhoods, and refused to lend or insure there. That redlining was not about actuarial risk. It was about racism and disinvestment. It created ghettos, entrenched segregation, and destroyed generational wealth for millions of families. Today, we are witnessing climate redlining. The logic is identical. Capital decides which places are too risky, abandons those communities, and leaves the state to manage the wreckage. Then it was race, now it is climate risk. But the mechanism is the same: private profit over public good, with the most vulnerable paying the price. And who holds the power to stop this? State insurance regulators can approve or deny rate hikes. In California, regulators approved a 17% average rate increase for State Farm in May 2025 covering over 1 million policies, to help the company cover more than $7.5 billion in projected payouts from the January fires. That is nearly double the previous record loss. Regulators approved it because they feared that denying it would push State Farm to exit the market entirely. But here is the rub. Regulators cannot force insurers to stay. They cannot compel reinsurers to underwrite risk. Insurance is regulated at the state level, but capital is global and mobile. When capital decides to leave, there is no regulatory lever to pull it back. The rules of the game give capital the power to exit at will, and the state is left scrambling to fill the void with underfunded public backstops. So let us ask the deeper question. Why is this happening now? Why are insurers and reinsurers fleeing American homes? The answer is not complicated. It is climate change. More precisely, it is the physical manifestation of a century of fossil fuel combustion. The wildfires, the hurricanes, the floods, the storms, these are not natural disasters. They are the externalized costs of the fossil economy coming home to roost. Fossil capital profited for decades by dumping carbon into the atmosphere, externalizing the climate risk onto the rest of us. Governments subsidized oil and gas, allowed emissions to soar, and denied the science. Now, the physical risks are materializing, and finance, always the most sensitive barometer of systemic risk, is refusing to absorb them. Insurers are the canary in the coal mine. They are telling us that the climate bill is due, and they will not pay it. You will. But wait, you might say. Is it not rational for insurers to exit high-risk areas? Is this not market discipline at work, sending price signals that discourage people from building in fire zones and floodplains? Is this not how markets are supposed to function, allocating resources efficiently and discouraging moral hazard? This is the steelman argument, and it deserves a serious answer. The argument goes like this. If insurance becomes unavailable or unaffordable in high-risk areas, people will stop building there. Developers will not invest. Home buyers will look elsewhere. Over time, population will shift away from danger zones, reducing future losses. The market is doing what it should, pricing risk accurately and encouraging resilience. Insurers are even innovating with catastrophe bonds and insurance-linked securities to bring new capital into the market. This is not a crisis. It is an adjustment. Here is why that argument is a myth. It ignores the fact that millions of people already live in these zones. They bought homes when climate risk was hidden, denied, or simply not priced into the market. The fossil fuel industry spent decades funding disinformation campaigns to obscure the science. Governments approved zoning and development in fire-prone and flood-prone areas without adequate disclosure of risk. Families made the biggest financial decision of their lives based on false information and systemic failures, not individual recklessness. Now, decades later, the market has decided their homes are in sacrifice zones. But these families cannot simply pick up and move. They cannot afford to abandon their largest asset. They are trapped. Moreover, the population influx into high-risk areas like the wildland-urban interface was not driven by recklessness. It was driven by housing affordability. As urban housing costs soared, working families were pushed to the periphery, to cheaper land on the edges of forests and coasts. They were not choosing risk. They were choosing survival in an economy that priced them out of safer areas. To call this moral hazard is to blame the victim. It is to ignore the structural forces, inequality, housing policy, fossil fuel subsidies, regulatory capture, that created this crisis in the first place. And let us be honest about who gets hurt. The families who paid premiums faithfully for decades, who never filed a claim, who maintained their homes and followed every rule, they are the ones being non-renewed. They are the ones watching their premiums quadruple. They are the ones being told their homes are now uninsurable. Meanwhile, the insurers who collected those premiums, who profited in the good years, are walking away. The contradiction is obscene. Insurance is supposed to be about mutual risk pooling, about spreading the cost of disaster across many, so that no one bears it alone. But when the disaster becomes systemic, when climate chaos makes the risk too large, capital abandons the pool. It turns out insurance was never about mutuality. It was about profit. And when profit disappears, so does coverage. So what comes next? Experts are warning of an uninsurable future in vast swathes of the United States. Not in some distant decade, but now, in the next few years. As private markets collapse, the federal government will be forced to step in, just as it did with flood insurance after private insurers abandoned that market in the 1960s. The National Flood Insurance Program is already deeply in debt, subsidizing risky coastal development and bailing out repeat claimants. A federal homeowners insurance program would follow the same pattern, socializing all the risk while private insurers keep the profits from safer markets. It would be another bailout for capital's failures, paid for by taxpayers with no accountability for the fossil fuel companies and financial institutions that created the crisis. This is the trajectory we are on. More homes will become uninsurable. More families will be forced into underfunded state pools or federal backstops. More communities will face economic collapse as property values crater and tax bases erode. More inequality will be baked into the system as the wealthy retreat to climate havens and the working class is left in sacrifice zones. And through it all, the fossil fuel industry will continue to profit. The financial sector will continue to extract. And the political class will continue to offer thoughts and prayers instead of structural change. But it does not have to be this way. We face a choice. We can let capital dictate who burns, or we can build a public insurance system that treats shelter as a right, not a commodity. A system that mutualizes risk without a profit motive, that covers everyone regardless of geography, that is funded by taxing the fossil wealth and financial speculation that created the crisis in the first place. We can demand managed retreat with justice, compensating families who must relocate, investing in climate-resilient infrastructure, and ensuring that no one is abandoned. We can hold the arsonists accountable. We can make the polluters pay. The question is not whether your home will become uninsurable. The question is whether we will let the arsonists walk free while you pay for the ashes. Will you demand that those who profited from the inferno pay to rebuild? Or will you accept capital's verdict that your home is expendable?